All right. Hi, everyone. Welcome to the third panel session of Finance on the Blockchain. This is regulation and the Howey test. Looking forward to an exciting panel discussion. Thanks, Arca, for setting this up. I'm Bobby Wenner. I'll be the moderator. I'm the Chief Legal Officer of Symbridge Capital at Digital Asset Securities, broker-dealer, and ATS. In terms of structure, I'll ask questions to the panel as a whole and hopefully have some lively discussion, and we will work to incorporate audience questions throughout. If you want to add that to the comment section on the right of the screen, we'll make sure to monitor what's going on. But as we get ready to start, I think it'd be good to begin with some introductions. And Gautam, you're on the top left of my screen, so maybe we can start with you and give a little bit of background on yourself and what Vertalo is doing in the space.
That's great. Thank you very much, Bobby. My name is Gautam Gujral. I'm the general counsel and co-founder of Vertalo. We are a digitally enabled transfer agent that connects various parties in this ecosystem. I've only had 2 jobs prior to forming Vertalo. I worked for 20 years at Credit Suisse. That's like 85 normal years. And prior to that, I was counsel at the Securities and Exchange Commission in Washington in the Division of Markets.
Sounds great. Annemarie, if you want to go next.
I think I have ADHD when it comes to jobs, so I can't match Gautam's terms, but I also started my career at the SEC. Gautam and I overlapped. I was in Division of Corporation Finance. I worked in private practice. I worked at the New York Stock Exchange. And then I went into the private company space with a company called Second Market, which morphed into what's now DCG with Grayscale and Genesis. So that's how I got my foot into the blockchain planet. I'm now a senior strategic consultant at the Chamber of Digital Commerce, and we provide policy and education around all things blockchain. So it's a very interesting space I've been in since 2012. It's a long time.
Sounds great. Thanks, Annemarie. And Cathy, if you want to go next.
Yeah, I don't know if it's like a bad thing that I didn't start my career at the SEC, but I think I've done okay without having done so, and Gautam and Annemarie like me. So I think that's good. I'm general counsel at INX. I think most relevant for this conversation, we are the owner and operator of a digital securities alternative trading system. I just want to give a quick shout out to Symbridge for getting approval for yours. Congratulations and welcome to the club. And before that, I have worked in the blockchain crypto space for the last few years. Definitely full-time since 2017, both on the advisory side, early adopters in terms of building a capital markets infrastructure for digital securities. Spent a number of years at BNY Mellon, where I actually first was exposed to the blockchain, the enterprise blockchain space, which really kind of catapulted me here. And I guess I started my career as a baby lawyer at Schulte, Roth & Zabel.
Great, thanks, Cathy. So we certainly have a wealth of experience on the panel, and I think we should have some good discussion. I think since today's really focused on education, and as sort of an introduction to the audience, could we kind of start with maybe a general high-level summary of where regulation stands today in the digital asset space, and specifically as it applies to digital asset securities and trading?
I mean, I'll start with an overall, kind of statement, and then I'll let the SEC experts kind of delve into the actual regulations. But, I think the funny thing from our position is that we have chosen to go down the regulated route. We have gone through registration. On the INX side, it's not only is it registration from a trading platform perspective, but also going through a registration process for a digital security as well. So, many of us operate under and welcome regulation and registration and licensing. And you would think that because we have gone down this route, there would be a ton of clarity and that we would be at an advantage. Unfortunately, that's really not the case. Even though we have chosen to go down this path, there is still there's a lack of clarity, I think. And I think we all still struggle to figure out the best way to allow our trading platforms to move forward, to be innovative, still being compliant with existing rules and regulations, but also still trying to figure out how do we progress, how do we create new products within the regulatory landscape, but also filling in the regulatory gaps.
From my point of view, I think that there's sort of a disconnect between what the SEC thinks is out there and what the market thinks is out there. And I think to Cathy's point, we often hear SEC personnel and even the chairman and commissioners state that they think there's sufficient clarity in the market for all of us to understand how to operate around digital asset securities. I think if you see the comment letters that people submit around what has been issued so far, or requests for no action letters, or reactions to enforcement cases, the market seems to disagree with that, I think, quite strongly. And I think we have a few issues. One, there is a very tried and true structure for broker-dealers operating in the unregistered security space. It's been a BD ATS structure that's well known for decades. The SEC, however, has been imposing additional obligations on broker-dealer ATSs that want to operate in the digital space purely based on how issuers are choosing to represent their securities, right? So you have one set of rules for certificated or uncertificated unregistered securities, and one set of rules for digitally represented securities, which are basically also uncertificated shares. So there is this disconnect that they're imposing through obligations for broker-dealers, obligations for custodians, obligations for transfer agents, which Gautam has extreme expertise around, that are only applied in the digital asset space, not in the traditional asset space. So that is a really complicated structure. And people have been asking for clarity or to help understand the basis for a bifurcated approach to regulation based purely on technology. And I think we've seen Commissioner Peirce, bang the gong very loudly, saying that she agrees basically with the industry. She proposed a token safe harbor that would help with analysis of whether a digital asset is a security or not a security. But I think on the part of the industry, I think most of us would agree that there is a significant amount of uncertainty, most of which is based on the only clear way that the SEC is communicating on their positions is through enforcement actions, which is not traditionally the way that they do things. So I think there's a real significant need for either additional rulemaking or actual rulemaking by the SEC in this space, right? They haven't actually proposed any rules here. They just put out statements or guidance or speeches, but nothing actually proposed yet, which I think is also quite unusual for the SEC.
I agree. It's a different way to regulate than what we've been used to in our prior lives, right? Which is you have certainty for the most part, and if you have any questions, you go in and you ask the questions, and then you get a written response, and it gets socialized in the industry, right? It's some of the things that, in addition to not having the clarity, some of the things that the SEC requires market participants to do can really only be explained as a regulation of technology. Because I'll give you an example, right? We are a registered transfer agent. We can keep all of our records in a shoebox if we want to, and the index cards. Obviously, we don't do that. But they trust that system more than the blockchain. So we're required to keep everything on a regular way database as well. We can keep, if we so choose, to keep a courtesy copy on the blockchain, right? Now, that to me is different than what the rules require for maintenance of records, which says that you're allowed to maintain your records on any database, right? So, so there is definitely and I'm not, you can call me Mr. Obvious here, but there is definitely a great hesitancy on part of the staff to actually allow people to do what the blockchain would really allow them to do, like what the technology enables.
And I don't know what you guys think, but I feel like the SEC, which is really, put a lot of effort into this space, right? They're trying they've created FinHub, they've created other processes to, try to keep up with the innovation. But it almost feels like the market believes that if they go to the SEC to talk through things, like they're not going to get a clear answer. Gautam, to your point, right? They're not going to get a no action letter. They're not going to get written guidance. And if they raise their head above the parapet and sort of say, hey, we're innovative and this is what we're doing, then the next thing is enforcement is going to be at their door. Now, that is not always fair, but I think that's what a lot of market participants feel. And I think for what it's worth, it feels like the SEC is conflating issues around crypto assets with digital securities, right? So they talk about loss of private keys. They talk about worrying about wallet access. So they talk about, hacking. None of those things exist in the digital asset security space, right? Every system like Gautam's has, or every issuer that's blockchain represented has the ability to, to adjust their cap table if something was stolen or misplaced. There's no concept here that you have the same risk around a digital asset security that you would have around my, Coinbase wallet, right? So I don't think they've had a lot of education that in fact is not a risk around digital asset securities, but they don't seem to be actually acknowledging that blockchain is just a different type of technology. And to Gautam's point, like electronic record keeping is a long-term way of satisfying the SEC's rules, but electronic can't mean blockchain, and that doesn't make any sense to me.
No, thanks, Annemarie. Thanks, everybody. Some great discussion. I think right at a high level, there's a lot of regulation that the SEC points to that's been pre-existing or predates the growth of the digital asset space. And one aspect, one component of securities regulation that they point to is the Howey test, and it's in the name of our panel, so I feel like we should probably discuss it a little bit here. But it's kind of been pointed to as a one-size-fits-all application for the digital asset space, and I think there's probably some good debate to be had as to whether or not that really makes sense given the growth of the industry. But maybe we can touch on that a little bit and kind of how the Howey test is used in its real application as the space continues to grow in different ways.
I mean, well, in terms of the security space, right, it's easy. I mean, an issuer will go out there and he will, or she, or they will issue securities pursuant to registration or exemption under the US securities laws, right? In that case, you don't really need the Howey test, right? Because there's like that assumption that like you are going out there selling a security at this point. But it's interesting when you see the SEC trying to apply this test to other blockchain-based assets, and that's where it gets really tricky. You have, and it's interesting because when you look at just what is being plainly issued as a security, and you look at the characteristics and how they're being sold and the manner they're being sold, it's pretty obvious. But then when the SEC has applied the Howey test to other types of blockchain-based assets, in my experience, the rule kind of goes out the window in terms of the four basic prongs of the test, because the SEC has also come out with the framework that they came out with a few years ago, adding some 50 some odd additional characteristics that they're looking at when also applying the Howey test. So in the end, is it really the Howey test that's being applied, or something brand new? So it's been difficult to look at it from that perspective.
And I think I would add, like, just for framework, for the audience, as Cathy said, like, there's been a framework for decades on how you determine whether an investment is a security or not a security. Tried and true, right? But it's only in the past, I don't remember when he gave the speech, but Corp Fin Director Bill Hinman gave a speech that basically said, the initial offering to raise capital to build out a protocol or build out technology is a securities offering. But at some point in time, the token that's issued around that protocol or platform can stop being a security and may become something else. And that's sort of like the holy grail in the securities industry is, what the hell does that mean? And how does something that's a security become not a security? The framework that you referenced, Cathy, as we know, was a process of providing a massive laundry list of items to consider about whether to determine whether what you've sold is security or not a security. But a lot of the people who are out there requesting guidance are saying, okay, well, when is it not a security? And is it in fact the token that's a security, right? The token's not an investment contract. So there's a whole huge range of crazy issues. And Gautam, I don't know what you think, but back in the day, when I was in Corp Fin, you were in trading markets, I don't think there was ever a construct that something is a security that now one day, but not a security the next day. And I think that's added a lot of confusion around the market and why people are really struggling to understand how they're supposed to analyze their activities and when is an investment contract a security and when is it's like the hashtag, have you seen it, oranges are not securities. So like going back to the Howey test, right, it was around an orange grove sale, and the sale of interest in the orange grove was a security, but the oranges themselves weren't securities. And so here the SEC is trying to extrapolate Howey to say that the equivalent of an orange is security. The whole market's like, wait a minute, we understand Howey. That's not how it's been applied. So that again goes back to the lack of clarity point. But Gautam, I'm sure
this is the Howey panel, right? But there's also another equally important precedent from the Supreme Court from 1975, I think it is. It's called the Furman case, right? And in Furman, the court basically said that even though something was called a stock, right, but because it allowed people to buy an apartment in which they could live in, and they had to pay less rent, basically, and the case before the court was like, is that stock a stock? Because a stock is a security under the Securities Act. But here they said, no, it's not a security because the person who owns the stock can't sell it for a profit, right? So if you take those two cases together, what it really means is that you have to make sure that if you're gonna do a securities offering, that as an issuer, that nobody can sell it for. If you want to avoid any risk of the application of the securities law, the sellers of the tokens have to make it impossible for the purchaser to transfer the tokens to others, or for the token to rise in value. And nobody would ever do that because that's just it's counter everything, right? Why would you ever do it? And and there was a recent article which I shared with you guys by Steve Lofsky, who says, the proof is in the pudding. Nobody has ever tried to register one of these securities because if you have 50 things that you need to take into account, I don't think there's another person that I could talk to where we would be in agreement about how everything comes out on those 50 items that you have to consider. So nobody's ever going to register these. And that's just very unfortunate because these utility tokens, they could be very useful, so to the market, to the economy.
But it kind of goes back to what we were saying before about how we're not getting no action relief, right? We're not able to go to staff. We're not able to present our products or our solutions, and to get you get a get out of jail card, free card if you live by like what you've presented. We're not even getting that right now. And the frustrating thing also is that where there have been no action letters issued, it's kind of stealing what Gautam said before. It's like being Mr. Obvious. In those cases, like I don't know why you would have even gone to the SEC for those specific cases where some of the early no action relief has come out from, to Gautam's point, there was no transferability. It couldn't leave a platform. You couldn't make a profit on certain things. So it kills me that good money and time was spent to prepare those things, to argue those things before the SEC when they're obvious points. And it's something that we should have just accepted. And I think, here we're missing that line of what's obvious and what's clearly not a security to what is clearly a security. And then there's this whole big gray area in the middle. And we don't even have, for the 50 points that came out in that framework, there's no even weighing mechanism. You don't know which of those points or characteristics are more dispositive than not.
I think, to your point, it's like Starbucks decides to tokenize its Starbucks card, and they have to go to the SEC to get a no action letter saying that that digitally represented Starbucks card is not a security. That's how basic the no action letters are that are out there, right? The fact that, somebody purchased something that was digital and they can use it for a service, but there's no other elements around it that even look like Howey. So I agree with you that that's, I think, and that's just positive of our conversation. If that's the level of guidance that they're willing to give, like, that's not guidance, right? It's like the framework or some other things, which is kind of like non-guidance guidance. Like, well, we're not going to tell you what to do, but here's a million things that aren't actually dispositive on your analysis, but you have to think through anyway. It's a very unusual situation.
No, that's great. Thanks, everybody. And I think that, right, we've really highlighted that there's a need for clarity in the space, and there's, guidance, and you kind of piece things together. But various, participants in the industry have published articles, blog posts, things like that in the past 6 months, advocating for different types or different forms in which the clarity could come to the industry. And one of the major proposals was for a crypto-specific self-regulatory organization. What does everyone think about that? An SRO specific to crypto, is that sufficient? Would that fit with the current regulatory framework? And if not, what may make sense in place of that to provide clarity?
Well, I mean, there is room in the Exchange Act for this type of SRO, self-regulatory organization, to exist side by side with other self-regulatory organizations, right? What causes me to doubt that it's a great idea is that it would overlap so much with what FINRA already does, because it's broker-dealer regulation, that then you would all of a sudden you'd have two SROs showing up at your door to do examinations as a broker-dealer, for example, right? And I'm not sure that's a great idea, right? I mean, we used to have a lot more SROs until the rulemaking on ETSs and exchanges was complete, and that allowed for SROs to kind of outsource their work to other people, and FINRA grew out of it, right? So I think that FINRA could probably handle it, right? But there would have to be the groups that deal with issues regarding digital securities. Those would obviously need to be expanded.
I think the challenge with that suggestion is that, kind of to our point, there's a bucket of digital assets that are securities. There are a bucket of digital assets that are commodities, and there's a bucket of digital assets that are neither, right? So NFTs, collectible, those sort of things, I wouldn't call those securities or commodities. So if you created an SRO, I think one of the tensions would be who oversights that SRO, right? So FINRA is oversighted by the SEC. So who would oversight a digital asset SRO? Does it have to deal with CFTC and the SEC? I don't understand how you would operate with two different oversight functions. And, right now, to Gautam's point, we have FINRA reviewing and examining all the broker-dealers and ATSs, broker-dealers in the digital asset security space. And then you've got the CFTC oversighting all of the digital commodity platforms that are starting to register with the CFTC. I think an SRO would be really helpful to kind of be the middleman and oversight the market, but I think it will be complicated. I've seen a couple of proposals for an SRO in this space where, again, like, they're oversighted by the CFTC and the SEC. And I think there's already a dogfight between those two agencies over regulation of this space. And I think without really clear lines of distinction from Congress, that could be super complicated. But I do think it could save a lot of pain for members if there was a consolidated, clear pathway forward to, compliance with all applicable rules.
Yeah,
you understand the applicable rules.
Exactly. My issue with having an SRO specifically for the digital asset space is, for years, the entire space has been complaining and yelling very, very loudly that the existing regulators are, in a way, punishing or scrutinize blockchain technology. The regulators say that they are technology agnostic, that they are not regulating technology. And everyone, who's active in this space, we say, yes, you are regulating technology. You're regulating this specific technology. And we're saying that you have to be technology agnostic. By asking for a specific regulator, an SRO, specifically for the digital asset space, I think kind of defeats all of our arguments that we are looking for technology neutral regulation. And, we live and breathe, exist wholly within the digital asset space right now, but it's this one emerging technology. There are going to be other offshoots of it. It's going to change. What we see today is not going to be what we're going to be dealing with in 5 years from now. So I think really what we need to do is educate more, have people get comfortable learning about emerging technologies very, very quickly, and really trying to figure out how to take existing rules and regulations to deal with the technology of today and tomorrow, as opposed to just, if we have put a framework around just for digital assets and there's a new technology or a new way of doing things 5 years from now, are we going to have another SRO or another regulator for that one? I think it's just impractical.
No, that's great. Thanks, everybody. So, if an SRO may or may not be viable, but another option for some regulatory clarity could come from Congress in the form of legislation. And there's been a lot of activity in past recent congressional sessions, particularly with the Digital Commodity Exchange Act, but a few others. What potential do you see for legislative clarity in 2022? Annemarie, I know you have a lot of experience with this in your work with the Chamber.
Yeah, the Chamber is putting a lot of time and effort into obviously tracking all ongoing piece of legislation, and have the honor and privilege of working with staff and Congress persons on different legislative initiatives. So the ones that are, I think, very interesting from a solving problems point of view would be the Digital Commodities Exchange Act, which was originally introduced in 2021, and that will be reintroduced in this Congress. And that lays out a framework for how the CFTC would regulate digital assets that are deemed to be commodities. It lays out frameworks for platforms to register with the CFTC. It lays out, an analysis of how you decide something's has a definition of a digital commodity, so that it actually helps define what is commodity versus security. So I think that bill is really going to be helpful. The other bill that's out there is House Financial Services Committee bill that will be reintroduced, I think, this session, which was introduced by Mr. McHenry, and that basically codifies Hester Purses Safe Harbor, token safe harbor, and gives issuers of investment contracts around digital asset platforms and technology 3 years to kind of build out that platform till it hits what's referred to as network maturity. And this goes back to what we were talking about earlier with the Bill Hinman speech and the framework, with nobody understanding when is something a security or not, and how do you analyze that framework. This bill would provide 3 years to build out your technology, build out your platform, get your network to a point where it's mature, either from a functional point of view or from a decentralized point of view. And then in that case, at the end of the 3 years, you would either say, yes, what we've issued is security, or what we've issued is not a security. And that gives them a nice 3-year safe harbor from having to second guess where they are in that evolution chain. There are some other, I think, really interesting bills that are perking around, haven't been dropped yet, that would go to the SRO point, that would go to a broader framework of jurisdiction amongst the different agencies. There's a bill that asked for a working group, the Eliminating Barriers to Innovation Act, I think it was called, that would require the CFTC and the SEC and industry participants to work together to identify a workable framework. To my knowledge, that bill has been negatively received by Chairman Gensler and may not be proceeding. So that would be a shame if we couldn't have industry participation around some of these conversations. And then there's other bills like a Token Taxonomy Act, Security Clarity Act, that help also go to a definition of what is what. what's an investment contract, what's an orange, like where are the lines? So I think all of those bills are really valuable. There's, bills circulating around stable coins. There's bills circulating around accounting for digital assets, which I think is also super important, and on tax. So there's a lot going on the Hill. And hopefully in 2022, we'll see some movement from Congress helping set forth the framework that the industry thinks is so important.
Thanks, Annemarie. Yep. So hopefully there's some good items on the agenda, for this congressional session. But even just not even a month into 2022, we have some action from the SEC. Just yesterday, they published some proposed amendments to regulation ATS that, whether intended or not, may have some consequences for the digital asset security space. Obviously a long document, but Hester Peirce was out with a dissent right after it was published. Does anybody have any initial thoughts on potential impacts for digital asset securities platforms?
I haven't, it's 650 pages long, and I've seen like short stuff on LinkedIn and Twitter, but I leave it to Cathy because I think she's read the whole thing, right, Cathy?
Oh yeah, that's why I'm in the dark, to hide all the circles from reading all 650 pages. I mean, I definitely haven't read it, and I do thank Commissioner Peirce for her dissent. I would not have paid attention. I mean, I would have paid attention to the proposed amendments since I am responsible for an ATS here, but I probably would not have paid much attention. I would have gotten to it eventually. It's very, very sneaky. There is, some problematic proposals and amendments in there. I think it's more problematic for those protocols that are not necessarily trying to operate in the digital security space, but it kind of falls along from what Chair Gensler has been saying, that a lot of these platforms should register, come in, speak to the SEC, and potentially register as an exchange or something like that. For me, I don't understand how a smart contract would be able to register as an exchange. And so that's basically how I look at it and what it boils down to. It's my first reaction when I saw the proposed amendments was the SEC is out of its mind. And it's one thing to say, and Chair Gensler has said this over and over again, projects should come in and speak with the SEC, that, projects need to register. Well, you know what? Some of these projects have actually gone in and spoken with the SEC, and they said, you know what? We're going to try to register. And they've gone through a registration process. They've tried to register, and Trading and Markets or CorpFin, they have no idea what to do with these applications because they don't fall under existing rules. They don't, accounting firms, if you're trying to register as a security, accounting firms have a difficult time certifying things because in their mind, what is trying to be registered is not a security. So I think there's a huge disconnect from the reality to kind of this overall overarching concept that everything needs to be registered. Well, you know what? People are trying to register and it's not possible.
Yeah, I think after the ICO market was shut down by SEC guidance that, these are illicit or illegal securities offerings, at least to my understanding, there was a lot of projects that went to the SEC and tried to register under Reg A+, so they could raise capital in the public markets. And almost every single project was blocked because the SEC has to qualify your offering, or the states have to qualify your offering. So my understanding is only 1 or 2 projects got through. But most projects spend a lot of time and money, legal and accounting, to try to get through that process before they were denied. And I think to Cathy's point, I've worked with a lot of SEC registered companies. To go through an SEC registration process, not an IPO even, but like a direct listing or something else, is a massive lift. You have to have several years of operations. You have to have audit financial statements. You have to have a lot of bells and whistles in place that these projects just aren't built. They're not operating companies, right? They're meant to be launching technology and then sort of decentralized and no particular entity running the project. So the idea of an ongoing disclosure regime around some of these projects also doesn't make any sense to me. So I do think it's a lot of a lot of questions about how a platform would register, how an issuer would register. And again, like at the end of the day, are these things securities that they are selling or that are issued as utility tokens? So they all goes back to like, why are they registering? If they're raising capital in private placements, why would they then also have to register with the SEC, or why would their products have to be traded on a registered ATS? It doesn't make sense to me.
Well, one thing, just coming back to the release yesterday, which none of us have read, right? But just if it's 650 pages, I'm going to make a wild guess here and say that most of it is unrelated to the digital asset space, okay? Because it's just too small at this time to warrant a very large release. So that brings up, in my mind, the question as to what's so wrong with the way that ATSs operate today in, let's say, the public markets, that they need this type of revamping.
I think, looking at it on its face, it relates to treasuries and some other, understood products. But they talk about, what's the term, Cathy? I don't remember, like communication platforms or something along those lines that people feel could pick up blockchain protocols or other things inadvertently. And I haven't read Hester's dissent, but if Hester's raising it as a risk, I think that's why people are paying very close attention to what otherwise would be kind of a run-of-the-mill rule proposal, other than to impacted platforms trading, treasury bills. So I don't know what the dissent says or why the market thinks that there's a risk here, but it seems like there are some definitional issues and some potential unclear points that need to be paid attention to.
Sounds great. So pivoting slightly to a topic that came up a bit this morning on the ATS panel, but DeFi is a growing industry segment, and it's hot right now. There are a lot of protocols with a lot of money floating around. From a regulatory perspective, where do you see DeFi kind of broadly fitting within financial services regulation, and what challenges do you see these protocols or platforms facing in 2022?
I mean, DeFi to me is, you have to look at it as something that's composed of some very essential building blocks, right? And then you have to take each one of those and analyze them to see, whether they already fall under existing regulation or whether the way that DeFi is developing, new rules need to be put into place, right? And those building blocks to me are stable coins, which are crypto assets that strive to tie the value to fiat currencies. There's decentralized exchanges, there's lending, and there are decentralized portfolios now developing as well. So to me, each one of those building blocks is ripe for regulation. So the fact that this is now all taking place in a virtually unregulated manner should, concern people who are involved in that space, right? Because and then the other thing I would say is that you don't have to just look at securities laws, because since so much of this are lending and collateralization transactions, you should also take a really deep look at the US bankruptcy laws or the bankruptcy laws of other countries in which you're operating, because you might be in for a very, very bad surprise, which is that you haven't priced your risk in properly, right? And the reason for I say that is because in the US bankruptcy laws have an exemption from stay. So what a stay means is when any party to a transaction declares bankruptcy, the music stops and you have to stop all actions. You cannot proceed against a bankruptcy estate, right? There's an exemption from that stay built into the US bankruptcy laws for things like securities lending transactions, repo transactions, margin loans, which I'm not sure anybody's looked into whether, what would happen in DeFi land if there was ever a bankruptcy, because I'm not sure that stay would be available to them. So that's my 2 cents on it.
I think that my 2 cents is it goes back to, again, to like multiple potential regulators. So like to Gautam's point, like who would regulate the DeFi space? Are these are these the types of transactions that the SEC would normally be regulating around like lending products? Or I've seen the arguments on the other side. These aren't SEC type of lending products at all. They're more bank loan structures. So who actually is the right regulator, I think, is the most important question. I think we're seeing, as we are with digital asset securities that are, or digital assets, either securities or commodities, we're seeing a lot of pull around DeFi about who would regulate stablecoins, right? Is that a Treasury Department regulation? Is it CFTC or is it SEC? So again, I think there's so much confusion around why a stablecoin would ever be deemed to be a security, right? It's fixed price. You can't make money off of it if it's tied to the US dollar or whatever functional currency it's tied to. So how does that have a security kind of indicia around it? I know that the SEC's like referenced Lending Club and Prosper as examples of products that were problematic, but those look a lot more like securities than we're seeing from a lot of these DeFi platforms. So I think, again, like clarity of regulation, Congress stepping in and sort of saying, okay, here's where the stablecoins fall in the panoply of regulation is essential to understand the space. And I'm sure that the DeFi platforms want to be compliant, right? They're not looking for enforcement actions. They're not looking for problems. They want to operate, in a compliant manner. They just don't know what they're complying with, I think, at least in some instances.
No, that's great. Yeah, there's certainly a lot going on. And this goes back right to the point that there's a lot of overlap in terms of jurisdiction. And I think we'll see, have to wait and see how things shake out. In terms of moving forward in this space, and referencing Prosper and Lending Club, that obviously predates to a degree the digital asset space, but a lot of the SEC's action has been through enforcement. And that's a lot of kind of the guidance that we've got to work with today, specific to the space. Looking ahead to 2022, are there any industry segments that you think may present priorities for the SEC in terms of enforcement or higher risk areas of the industry that the SEC may be focusing on?
I mean, they've spent a lot of time going after issuers, right? I wonder if the next port of call is the trading platforms, and taking the position that what they're doing is trading securities and that they need to be an ATS. A platform that's trading in unregistered securities can't be a stock exchange. So when Chair Gensler was like, they should be an exchange, a registered exchange, like, to my mind, I don't understand how that's even possible. I can see how a platform like Cathy's INX could be trading digital assets that are deemed to be securities through her broker-dealer ATS structure. That's completely understood. I think a lot of the exchanges who are trading crypto assets are trading them in a regulated framework of money servicing business money transmitter licenses, which are extremely time-consuming and expensive to get all of the licenses out there for money transmitters at the state level. So there is a regulated structure around these platforms. I mean, I thought it was really funny when the SEC said that they had no visibility at all into how any of these things are operating, when Coinbase is a publicly registered company and has a very robust, series of disclosure documents on their website. I have to assume the SEC has access to whatever is happening on Coinbase as part of their oversight of publicly registered companies. And we've seen recently more, I think Coinbase just acquired a futures exchange. Gemini got approval for a broker dealer. So I think a lot of the crypto exchanges are moving into the BD ATS, regulated CFTC entity space, maybe so they have the ability to trade whatever they want once they understand what bucket things fall into, right? And not have enforcement or FINRA knocking on the door saying, we disagree with you. But maybe that's the next space they look. I don't know.
But that's also problematic because, going back to what Chair Gensler has said, I mean, he says that a lot of these things look like securities and they have to go through the disclosure regimen. There needs to be KYC, AML, but the SEC also can't come in and say, all of these tokens, you have to burn them. They can no longer be in circulation, because that in of itself would actually harm the very investors that they're trying to protect, right? So you're saying registration, they look like securities, they have to be treated like securities, they should only trade on regulated platforms. Well, my CEO would love to have all of these, securities listed on our, not securities, but these tokens that the SEC deems to be securities. He would love to have them trade on the INX ATS. But the ATS, unless they have been issued as securities pursuant to registration or exemption under the US securities laws, we cannot meet our obligations as a broker-dealer and an ATS to list them. So if you're saying that they look like securities and they should be treated as such, well, then give us a way to figure out how they're going to look like securities, or just accept that they are not securities.
Yeah.
So it's this whole, like, you can say all of these things and make these proclamations, but until you're going to come out with a realistic solution, we're kind of at a standstill.
Well, you do have that additional problem too, Cathy, right? Of the December 23rd, 2020 no action letter. It says that if you are in fact going to trade them on your ATS, you have to first make a determination that they are a security, right? Otherwise,
the special purpose broker dealer statement, right, Gautam? Yeah, that's another happy Merry Christmas present. Yeah. Last year. Yeah.
Right.
Yep. But that to me is, that release actually just, I know Cathy doesn't like it as much as she would like to like it, because it doesn't answer all the questions. But see, that I actually viewed that release in a more positive light than most people, and the reason for that, my view, is that that was kind of like the starting gun for ATSs to say, okay, these are the minimum standards that we have to live by in order to be a special purpose broker-dealer, which I'm now required to be if I want to trade tokenized securities, right? So that, to me, was probably the last year or so, probably the most important pronouncement that has come out from the SEC on this topic. But, I mean, it could have gone a lot further and been a lot better, but at least it allows for the sandbox for people to start experimenting within a sandbox, right? That unfortunately doesn't protect them to a degree that a general counsel would want to protect its own ATS from regulatory scrutiny, because there's, as we've already discussed, there's a lot of things that are unclear about it, right? But the one place where I take issue with that release, right, is that they require you to have this. They require basically two types of broker dealers. If you want to trade privately placed securities on your ATS that are only represented in, let's say, electronic format, right? Then you can do so in one broker dealer. But the moment you trade something that is a security that is also represented on the blockchain, you have to go to a totally different broker dealer. You cannot have that security in that same broker dealer. And I don't really understand it. Imagine a scenario where somebody comes to sell a token in ATS, and the token never actually comes to the ATS. All the ATS does is inquire from the issuer, from the transfer agent, does Cathy, who wants to sell 100 shares of XYZ, does she actually own it? And the answer comes back yes. So they facilitate a trade on the ATS. It gets settled away from the ATS, and the issuer or the transfer agent updates his books and records. The fact that there was a courtesy copy on the blockchain has no effect whatsoever on the trade that took place on the ATS. Yet you have to somehow, for reasons that are completely unclear to me or anybody else that I've talked to, have two separate broker dealers to effectuate Cathy's two trades.
Right. Well, you know what I think of the release. I said it at the Vertalo conference. It's crap. I mean, and I got a lot of crap for saying crap, but it just brought up more questions. It didn't answer anything. It doesn't really give a way forward. But of course, like every piece of guidance that has come out from the SEC in the space, like the joint staff statement on custody that came out a few years ago. There were many participants who ran to the SEC and said, "Hey, you listed out all of these concerns. Look, technology solves for all of it. There are smart contracts, there are protocols where you can get rid of the risk of losing these digital securities. You can reissue them. all the concerns, people went and they tried to say step by step, we have answered all of them, we have a solution for all of them. Here with the 5-year safe harbor for special purpose broker dealers to custody digital assets, that there was a rush of applications, new membership applications, probably continuing membership applications to be able to do this. I have heard that none of these applications are able to go through because FINRA can't process them because they have the same questions we all do in terms of, well, how exactly do we push this forward? Because there's a lack of clarity from the SEC.
And I think this goes to one or two of our original points, which is the special purpose broker dealer framework was issued as a statement, right? So they issued it. They had been getting a lot of questions about why broker dealers could not be involved in closing what would generally just be an unregistered security transaction. They can trade those day and night, not day and night, during normal trading hours, on any kind of private company trading platform that does this for a living. But, to your point, the second the word digital gets involved, there's a completely different framework. So instead of saying, okay, the ATS can refer to the transfer agent, and in fact, in the private unregistered security space, there's no obligation to have a registered transfer agent. There's no obligation to involve a custodian. There's no obligation that the broker-dealer can't actually direct the closing of the transaction, and that it has to happen somehow through the transfer agent or custodian. None of those are traditional processes around private unregistered securities sales. So they've imposed all of these obligations. They gave the public an opportunity to provide comments, which many did, but it wasn't a rule proposal with a comment process and then a final rule. It was just a statement that's out there for 5 years with many elements that a lot of people think, to Cathy's point, are unworkable or confusing, including FINRA. So how is it helpful to issue something, not acknowledge that there's required additional clarity, and then not provide the clarity? And the idea of limiting a broker dealer to either traditionally electronically represented securities or blockchain represented securities, again, to Gautam's point, that just doesn't have a bearing in risk. What are they trying to solve for? And it doesn't make any sense. And the chamber submitted a letter to that point. Some of our members were fans of it because at least they gave some way forward for like you said, Cathy, for a broker dealer to custody securities. But a lot of our other members said, well, we have already gone through the process of getting approval for our BDATS for private unregistered securities, primary and secondary. And we might have the ability to do digital secondary trading. Do we have to give up our traditionally represented private placement business? Like Gautam's point, who can afford to have 2 broker dealers where you're getting a business off the ground? So right. Again, just a very clear example of what at least I would personally, in my own opinion, and the opinion of a lot of other people that I can't speak for, of course, how's that not regulation by technology?
No, that's great. Thanks, Annemarie. So we just have a couple of minutes left, and I'll turn it back to you guys for any kind of final thoughts, maybe predictions for regulatory clarity in 2022. But this was a great panel, so thanks everybody.
I'm kind of thinking back on this conversation, and it's unfortunately sounded so doom and gloomy, and it's not supposed to be a letdown. I think what we didn't get to, and I think the earlier panel on ATSs did cover it, there is a lot of positive movement going on in this space. There is traction for digital securities, and despite the lack of clarity, there are digital securities ATSs who are pushing forward. They are trying to attract new types of issuers. There are new types of securities offerings that are out there. We're pretty much following Chair Gensler's concerns in terms of, we are registered, there is KYC, AML, we're checking off all of the boxes. And so we're trying to do what we can despite all of this to really come up with exciting investment opportunities for investors.
And I think the other thing to keep in mind also is that it's not just those of us in the business that are, pushing this. There are customers out there that are pushing their own broker dealers to say that, hey, I want to buy these other assets. I want to buy digital assets. I want to invest in them. I want to hold them. Can't you accommodate me? If the answer is no, then they're going to start losing those customers. But they hate losing customers. So what they're going to do instead is that they too will start pushing for clarities. And so Cathy and Annemarie and all of us will have even more support, to go into the commission and say that, listen, we want to do the right thing. Okay, help us here.
And I think my closing point is, I do think there's a lot of positive momentum. I think the other points that are really important to remember is that at the end of the day, an issuer gets to choose how their securities can be represented, right? So certificates, electronic book entry, or blockchain. The state of Delaware changed its laws in 2017 to give issuers that exact choice. And the idea that an issuer choosing to represent their securities in a blockchain format, again, has created an industry of questions and concerns. I think the SEC I think they must have a good understanding that there needs to be continued additional clarity. But what I would like to see is for that clarity be issued through kind of binding rule proposals, no action letters, or, things that we can actually rely on and understand. But I'm a big fan of the SEC, so I'm not bad mouthing them, but I do think I don't agree with everything they say.
Sounds great. Thank you, everybody.
Thank you.
Thank you.
Thank you.